Well, there's one more thing you got to do before you go on vacation from school, and that's take that final exam. So it's appropriate that perhaps we review the calculations associated with financial theory. Well, the first one's pretty darn easy and turns out to be relevant later on. We live in an after-tax world. People pay federal tax, maybe state income tax, sometimes even a city tax. And let's say you made 9% and you're in the 1/3 bracket. Well, that would be 6%. You keep the remaining 2/3. On the other hand, maybe you have something that's tax-free, like a municipal bond. Turns out it's going to be the same regardless. Well, our next one is ratios. It allows one to compare unlike firms, at least in terms of size. The two biggies are return on assets, that's for the internal managers, and on return on equity, that's for the external owners of stock. Well, the ROA, well, it turns out you could do the accounting, but instead it turns out it's just the profit margin times the sales asset turnover ratio, because the two components there cancel, leaving the return on assets. In this example, profit margin of 3%, turnover of 4, gives us a 12% return on assets. To get the equity, well, let's see. We have 15 in assets, 5 in debt. Well, that leaves 10 in equity, so that's 15 to 10. So we're going to take that 12% previous for the ROA times 15 over 10, assets over equity, gives us 18%. Well, a variation on a theme here with a slightly different setup. Here we have a firm that has a debt-equity ratio of 1:3, profit margin of 5%, sales asset turnover of 3, and again we want to know the ROA, return on assets, ROE, return on equity. Well, the ROA is 3% times a turnover ratio of 5 gives us 15%. And here's the twist this time. With a debt-equity ratio of, let's say, 1:3, I guess that'd make 4 in assets. Well, that'd be a 4:3 asset-to-equity ratio. Or a shortcut in this case of a 1:3 debt-equity ratio is you just add 1. So 1 plus 1/3 gives 4/3. In either case, we take the 4/3 times the 15%, gives us 20% for the ROE. In going from ratios which can be either asset, liabilities, equity from the balance sheet, or from items from the income statement, here we're going to look just at the income statement, and that is we're going to try to ascertain the cash flow and something called the EBITDA. That's the earnings before interest and taxes and depreciation and accruals. Well, the cash flow is net income after tax plus depreciation. Contrast that to the EBITDA, that's the earning before interest and taxes plus depreciation. In this case, what we're trying to do is undo the accounting statement to find out what's in the front of the business as opposed to the back of the business, meaning the fixtures and the inventory and the building doesn't know whether it's owned, paid for, or leased, and that depreciation, deferred cash item, is only in the case of ownership. It can change. So let's say we have a firm that has revenue of $8,000, paid costs $6,000, but has depreciation of $500, interest of $300, and they tax the net at 25%. Well, let's first of all figure out the earnings before interest and taxes, the net income after tax, then the cash flow, and the EBITDA. For the EBIT, earnings before interest and taxes, well, we have $8,000 coming in, $6,000 going out, and the depreciation, $500, $1,500. Net income after tax, well, that's $1,500, minus the $300 in the case of the interest expense, and minus 1/4 of that previous net amount, $1,200. A quarter of that is $300, so another $300. So we have $1,500 minus the $300 gives us $900. For the cash flow, we take the net income after tax, we just figured it out, $900, add back the depreciation, $500, gives us $1,400. For the EBITDA, the front end of the business, if you will, we will take the EBIT of 1,500, add back the 500, gives us 2,000. Notice the difference between those two figures. The 1,400 and the 2,000 is 600. Where did that go? 300 went to the interest. The other 300 went to the taxes. So everything checks out. One of the basic calculations in finance is present value. It's, if you will, the opposite concept of future value, and it's more useful because when do we live? Right now, in the present. Well, we got three concepts: a single sum, and an annuity, that's a stream of payments through a period of time, and a perpetuity, that's a perpetual annuity. Well, let's do a couple of them. Here we have $2,000, respectively, at year 6 at 8%. Periods 1 through 6 at 8%, and forever at 8%. Well, let's see. The first one is $2,000. Go to the table. I'll show it to you in a second. And it's a single sum because it's always less than 1. 0.63, $1,260. If we had a stream of those payments 1 through 6, that would be the summation of all the single sums. We'd go to the table. It's always less than the number of periods. And, well, that's 4.623. Multiplied, we get $9,246. And, well, what if we did it forever? We just divide by the discount rate, here 8% as a decimal 0.08, and we get $25,000. Let me show you the tables. And here are the present value tables as opposed to future value. And the top one happens to be the single sum, what the accountants call the PVIF. And the lower one is an annuity table, what the accountants call PVIFA. Don't get me started. Well, you may say, why don't I use a financial calculator or a spreadsheet? You can. But how do you know whether you're doing it right unless you actually have at least once verified the table? You know, some of the calculators are in decimals, other percents, end of the period, beginning of the period, monthly. We're teaching literature, not how to type. Well, we're going to start to bring this together. Here's a simple example. We're going to complicate it a little bit later. We have discounted cash flows. Look at that notation. You don't have to worry about that. Firm earns $400 a year, has cost of $80 a year for 5 years, and we're going to use a discount rate of 7%. What's the present value of the cash flows? Well, first of all, make them net cash flows. 400 minus the 80, that's $320 a year. We go to the table for what? Well, for 5 years, look up the factor, 4.1, we get $1,312. Well, another place we use present value is in the case of bond valuation. Bonds typically are priced by 100% of face value, so the interest rate times the face value will give us the interest payments, and the face value is, well, 100. The interest payments are an annuity. The face value is a single sum. So here we have a bond that pays 5% a year. Let's do annual compounding. In the real world, it's twice a year, half the amount, close enough for government work. But in any case, so it'll mature in 9 years. We want a 4% yield. By the way, think about it. If you have a bond that pays 5 and you only want 4, probably should be worth more. We'll see. Well, the interest is 5 points. The face value is 100 points. The interest at 5 is an annuity. Look it up on the table, 7.435. And the face value is a single sum, 0.703. Add them up, we get 107.475. That to stay 7.5% above face value, confirming that we know bonds trade at a premium when the discount rate is lower. We're going to revisit that previous problem I mentioned. Again, the firm earns $400 a year, has costs of $80 for 5 years, and now we have a tax rate of a quarter, 25%, and pre-tax interest rate, sole cost of capital, we'll look at that a little bit later, of 12%. What's the present value of the cash flows? Now we got to make them after tax, so we have $320 net, but after tax times 3/4 gives us $240 a year, and the discount rate is, watch it, 9% again after tax. So here the factor is 3.89, and contrary to your intuition, notice it's a different valuation. Here, 933.6. Well, we did bond valuation. Let's do common stock valuation. Well, it turns out you can either have a model that does dividends right now, we're going to have to adjust for that, or dividends next year, a little bit simpler. Let's start with a more difficult one. Just paid a dividend of $3 a share, grows at 4%, and is to be discounted at 12%. Well, dividend increased by 4% because we need the next year dividend, divided by the discount rate minus the growth rate. Well, we have $3.12 divided by that net difference of the discount rate and the growth rate of 8%. Here is a decimal, 0.08. We get $39. Let's now do a different one. A stock will pay a dividend next year of $2.40, is growing at 3%, and the discount rate is 9%. Its value would just be the $2.40 divided by the difference between 9% and 3% as a decimal, and we get $40. Remember that example we did before? Well, we're going to make it a little more realistic, if not a little more complicated, but that's okay. That's the name of the game. We have a firm again earning $400, cost of $80 for 5 years. Tax rate again is 1/4, and we have a pre-tax interest rate of say 12%. Let's say we're just borrowing money here, and but now we can purchase it with $250 and depreciation of $50 a year. That's straight line depreciation, and no salvage value. Or we can lease it for $160 a year, and we're going to use end of the year payments. Well, just before in our previous after-tax example, we still have incomes having a present value of $933.6, exactly the same. But now the twisteroo here is we're either going to look at the purchase or the lease. In the case of the purchase, there's a one-time payment going out at year 0 of minus $250, no tax consequence. We're going to have a depreciation expense of $50, but that turns out it's a non-cash item, but it saves us 1/4 on the taxes, saving $12.50 on taxes. We're going to look at that after-tax factor we used before for the annuity, 3.89, and we work that all out, and we get minus 201.375. We net them out for the net present value. The revenues coming in, cost of the purchase, net present value for the revenues and the purchase, $732 and some change. Contrast that to the mutually exclusive choice of the lease. Can't do both. Lease cost us $160 after tax. And we're going to look at this using end of the period payments on that 9% after tax cost of capital. Well, first of all, that's minus $160 after tax going out. A couple of tricks here, but first of all, to recognize a present value postponed becomes larger, so we could multiply, let's say, times 1.09. That would give us the factor of 4.24. We get minus 503.8. Or a little trick of the trade, because periods 1 through n is not the same as periods 0 through n minus 1. We're using begin of the period. Well, that means let's go up a row, in this case not 5 but 4. Add 1, because the present value of $1 today is $1. We add them together, and guess what? We get the same factor. 1 plus 3.24 is 4.24, times again the minus 160, gives us minus again 503 and some change. Net present value against that previous revenue, we get 429 and some change. Well, it turns out we would prefer the purchase, but that's dangerous. And a purchase is dangerous because you're married to it. You're stuck with it. And, oh, yeah, I could sell it. Guess what? You probably want to sell it when everybody else does. Yeah. Well, let's see. With a purchase, you have to deal with obsolescence risk, technology changes, style changes, business risk. And indeed, recall that, well, a lease has negative payments. Revenues are positive payments, so they kind of dampen each other as the interest rates change. Whereas in the case of the purchase, they have positive tax shield from the depreciation. The revenues are positive, so they both go the same way. We're going to see that in a little more detail. So with a purchase, no surprise, it's probably more advantageous, less costly in terms of the purchase. And the lease is more expensive, but you may want to pay a premium to avoid those risks. Before we go to our next one, let's do a little graphical review before we go to the numbers. We got a loan, a purchase, and a lease. And, well, let's see, the loan becomes more valuable, positive, when you are in a higher rate world, when you can borrow at a lower interest rate. The purchase is a little bit steeper. The lease is a little bit less steep, but do decline as rates rise against, say, revenue. And the one reason for that is the purchase has positive cash flows with the depreciation shield, just like the revenue. They go the same direction. In the case of leases, the lease is in the opposite direction from the revenue, so it kind of dampens it. Notice where they cross the zero line. Those are the internal rates of return where the NPV is zero. And if you're evaluating them at the cost of capital of the after-tax self-same for the loan, turns out the net present value is zero, and you can exclude it from the computations. Here's our three projects for this particular example. We got X, Y, and Z. Well, the net present values for them respectively are 35, 30, and 15. The internal rates of return are 2%, 7%, and 4%. Now, it turns out we have different rules for different situations, and they make sense if you think about them. Suppose we have $300, but notice these add to $450. We can maybe do two of them. And we have a store, the same store with a purchase and a lease, and another same store with a different lease. We can only do one. So which one? The one with the highest NPV. Here, that's X. But suppose I again have $300, again costing $150 each. We can do two of them. One's a store, a repair shop, and a restaurant. We can do combinations. We would use the ones with the highest internal rates of return, which turn out here to be Y and Z. Or for you Canadians, Z. Before we go to our next one, Markowitz showed that risk return always bends to the left in terms of risk. And when we add in the preferences that most people have, it turns out people want to be up in return, lower in risk. They hate losing money. And when we add in the risk-free to that feasible set, which we show is smooth and continuous to the left, its tangent at one point, we'll assume it's the market, and that creates the capital market line. And people will move from the upper frontier of the feasible set only to the capital market line using the market and the risk-free. Well, that creates the security market line in terms of beta. The beta of the market is 1. And indeed, graphically, as a reminder that the slope must be the return to the market minus the risk-free, because the run is 1. And so we're going to add that to the intercept of the risk-free. So any security investment that's above it we'll accept, any below we reject, and we'll even accept a project that's below the market but a little above the line, and we call those a cash cow. So let's take that, what we now call the CAPM. The intercept is risk-free times the beta, the covariance divided by the variance if you insist, and times the market premium, which is the return of the market minus the risk-free. Let's say we have two securities, investments. A has a beta of 2/3 and makes 8. B has a beta of 1 1/3, 4/3 if you like, and a return of 10%. The risk-free is 3, and the return to the market is 9. The market premium is 6. What should they be, and should we accept and reject? Well, for A, it's that 3 intercept. 2/3 of the premium is 6, is now 4. Add them together, we get 7. But it offered 8. 8's greater than 7. But below the market, it's a cash cow. Everybody go moo. And then we have B, again the same intercept of 3. The beta is 1 1/3. 4/3 of the premium of 6 makes 8, and 3 makes 11. But it only offered 10. Even though it was above the market, we're going to reject it because it should have made 11. In doing that NPV problem previously, you might remember we assumed maybe to make it easy, it was all debt. Well, it doesn't have to be. Maybe we're also using some stock. And, well, let's see, the weights in anything add to 1. So maybe we have a debt-asset ratio, and that would apply to the debt, wouldn't it? And the equity would be 1 minus that. And we're going to do the interest after tax, and we're going to use that stock valuation model and solve for the K discount rate. And it turns out to be the 2 rates. That's the current yield, dividends over price, plus the growth rate. First example, firm has $3,000 in debt, $9,000 in equity, 12% on debt, 1/3 tax rate, a $3 dividend on a stock with a price of 60, growing at 3%. You want it to be a marketing major? Remember, you're going to be paid for this. What is the weighted average cost of capital? Well, with 3 in debt, 9 in equity, the total's 12, so it's 1/4 and 3/4 weights. The interest is 12%, but remember, it's 1/3 tax rate, so we keep 2/3 of that, it's 8%. Then we have 3/4 times the cost of equity. Well, that's $3 over the 60 price for the dividend. That gives us, well, plus the 3%, 5%, gives us 8%. Notice I converted here from decimals to percentages. Either's okay. Weight them, add them up, 8%. Here's a second example with a variation on a theme. Here we're given the firm has a debt-asset ratio of 20%. Tax rate is 40%, interest rate is 10%, stock pays $5 on $50 with no growth. Its weighted average cost of capital, well, that's 20%, times the 10%, times 1 minus the tax rate of 40%, doing the decimals here, and the weight in equity is 80%, 1 minus the 20, and, well, let's see, the cost of equity is 5 over the 50, that's 10, and plus 0 is still 10. Weight them out, we get 9.2%. Using these if you're using funds for both equity and growth for perhaps project evaluation. Here's our next topic. It's called the economic order quantity, originally by Tobin and Baumel. And some people will say, but I use just-in-time inventory. But wait a minute. To figure out the proper just-in-time inventory, you still have to use the model. Do you want 1 truck a week, a carload every month, a pickup every day? It still answers that question for you just-in-timers. You have 2 costs. Ordering declines hyperbolically there because, you double it, halves, double the size again, halves again. The inventory, on the other hand, is 1/2 the average. Add them up, and there's a minimum. Well, the equation for the total is on top. Take the derivative of that, solve to 0. Don't worry about the proof. And it turns out to be, well, here's your mnemonic, King Tut overseas. 2 times the usage, say annually, times the transaction cost per order, divided by the carrying cost. Take the whole square root of that. If the carrying cost is per unit and it's units, that's fine. If you're doing dollars, you would use an interest rate because what is an interest rate? Dollars per dollar. Let's do an example. A firm uses $40,000 a month. Watch it. $6 per order. Interest rate is 9%. What should it withdraw? How often? And what's your annual cost? Well, let's see. It's King Tut overseas, so it's 2 times the 40,000. Watch it, times 12 per month to make it annual, times the $6 transaction cost, divided by 9% as a decimal. Take the square root, we get 8,000. How often? Well, our annual is 40 grand times 12 divided by the 8 is 60 times a year. And check our total equation. Well, let's see. 1/2 of 8 is 4 times 9%. 60 orders, $6 per order. 360 plus 360 gives us 720. By the way, notice that graph? The answer is proper when the 2 components cross, and they're equal here. It is correct. How about do something maybe a little bit easier, and that's called break even. It's where you have zero profits. You're going, I don't want to make a zero profit. It's a feasibility study. Doesn't tell you what price you should charge. That's for the marketeers. It just says, what do we need to do to get out the door and at least stay in business? Well, if you take the profit equation, revenues minus cost, costs have a variable and a fixed component, and you solve for the quantity, turns out it's the fixed amount divided by the dollar profit per unit. That's price minus variable cost. Here we got an example. Company has rent, salaries, and insurance of $100,000 a year. Sounds like a fixed cost to me. Labor costs of $20 an hour, making 4 units per hour. Hey, that would be $5 per unit. And plus raw materials of $3. That makes $8. And is considering two prices of $12 a unit or $16 a unit. Let's see what the quantity is for break even. And oh, by the way, what would that be in dollars of revenue? Let's do the $12 scenario. We have $100,000 in fixed cost. We have a profit per unit of $4. That's the 12 minus the 8. Divide through, we get $25,000. And times the $12 gives us $300,000. At $16, we should get a lower break even. And at $16 minus the 8, divided through, we get 12,500 units. Times the $16 gives us $200,000 in revenue to break even. Well, here's our final topic. It's foreign exchange. And the trick here is maintain a viewpoint, one country or the other, and keep it. Let's say we open 2 accounts, here and there. Well, here, we make the rate of return locally. And when do we make the exchange over there? Later, a future exchange rate. The account we open overseas, it's already there. When do we make the exchange rate? Now, that's a spot market price. Open 2 accounts, whatever ratio that makes them equal is the future exchange rate. Gave you an equation, but let's maintain that opening 2 accounts approach. Before we start our first example, here's a concept check. If the local return is higher, the local currency should drop. If the foreign return is higher, the foreign currency should drop, both of them with the currency in the denominator. If otherwise, then it's the opposite. Remember, exchange rates are reciprocals of each other depending on your point of view. We're going to maintain the same point of view. In the case of the U.S. return, say, being 4%, Mexican return is 16%, we currently have a peso worth 10 U.S. cents, and we want a 180-day future exchange rate. That's about a half a year. So we're going to take half of those 2 rates of return. So the U.S. rate is now 2%. The Mexican rate is 8%. The U.S. account is going to make 2% on the 10 cents, the equivalent, giving us 0.102 American cents. The Mexican account in pesos, that's 1 peso, is increased by 8%, giving 1.08 pesos. The ratio, here quoted per peso, divided by pesos, gives us the answer of 0.0944 cents per peso. And notice, the peso dropped, correspondingly offset the higher return in Mexico. Here's our second example. We got a couple of twistaroos here. We have current spot price is 70 cents American per Swiss franc. We have a 60-day, 1/6 of a year, future exchange rate for the franc is 0.714 U.S. dollars. The return in the United States is 12%. What should the Swiss return be? This time let's plug it in the equation. So we have 1 plus 1/6 of 12% as a decimal, now 0.02. And we're going to divide by the dollars per Swiss franc. Why? Because the American account is in dollars, and if we multiplied, we'd get dollars squared. So we're going to divide. Then, on the other side, likewise dividing by the 0.70 spot, because that goes with the overseas account, and when you solve it through, the rate of return, in Switzerland has to be 0. Look at that. We got 2% at home, but the Swiss franc rose by 2%. The net offset was we needed nothing more or less in Switzerland with Dr. C Invests. Good luck.